Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The stock markets had nothing surprising, but the crude sector performed better than expected, and that gave the Canadian dollar some life. Publisher of the realestatetiming.com newsletter, Robert Campbell, gives us a view on what's happening with U.S. real estate and whether the big increase in home prices is sustainable with more mortgage rate hikes likely. WolfStreet.com publisher Wolf Richter tells us the U.S. consumer is switching their buying from goods to services and how what's happening on the stock markets is echoing the 2000 dot-com bust. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be with you, Jim.
Ross, another very interesting week on the stock markets. What's the story there?
This is one of those weeks where you move with the economic numbers, and which means that you're up one day, down the next. So overall, the stock market, if we look at it, is a flat week with a bit of chop to it. Nothing really exciting as far as the overall market is concerned. If we look at the indices, they're pretty much just moving sideways. When you delve into it and start to look at some of the sectors, once again, not too much in there unless you get to the oil market. And the oils had a pretty darn good week on the U.S. and the Canadian side. Some of the stocks there are looking at a good 2 to 3% on the upside as far as the oils are concerned, and Canadian side oils even a little bit better than that. So, but when we look elsewhere, pretty much a downer as far as the tail end of the week, and the Friday itself. Down a fair amount, pretty much across the board.
What's the story with gold?
Gold, we had a nice buy signal back on May the 12th on the weekly charts when we were down at 1,800. Had a reasonable bounce into the middle part of the week. But closed off around 1853. This is looking like a pretty nice bottom in here as far as we're concerned. And I think that as we move through the summer, you're probably looking at something in the mid-1900s. That would be a reasonable bounce out of the oversold low that we had. And, it's one of the few sectors that you might want to look at taking advantage of. And the miners had the same type of bottom. They bottomed backed out. If we look at something like the XAU, bottomed at 120, has bounced back. It's around 133 right now. And I think you're looking at a level. There's a nice gap to be filled up around 150, and that looks like a reasonable target up there.
What's happening with the Canadian and U.S. dollars?
Canadian dollar finally has had a little bit of life. I've been really questioning it in the last month. Its inability to have life with the energy markets, or the oil market, and the stocks, or the agricultural market with corn, beans, and wheat. But this week kind of proved me wrong on that one. Nice little rally. The dollar closing at 79.40 after having spent the last couple of weeks under 78. So in terms of where it goes from here, it has been now at least shown some reasonable strength with the commodities, and has a chance to maybe test the 80 to 80.5 cent level.
Anything happening in the crypto market for us to be aware of?
No, sort of another one of those quiet ones here. We had a nice capitulation low right at the bottom here, put out a signal on coin back on May the 12th when it was down at 43 3/4 and rallied to 80. If we look at the BTC, which the futures index there, same type of signal, bottomed at 28,000, bounced to 32, and has now gone into just a consolidation phase at 29.5. But I don't see too much excitement in there. Maybe a retest of that 32,000 level. We're entering the summer. Doldrums would not be surprising here, and I think in terms of traders, you clearly want to be looking to just look at it as a short-term market as far as investments are concerned. Trades that are good for maybe a week or so. Get the oversolds, buy in there, and sell into rallies. But unless you're starting to position for a larger move on the upside in the next few weeks. So unless you've got an outlook that is longer than just the next few weeks, I think you want to make sure that you're just looking at very short-term trades and don't have any big expectations right here.
Ross, thank you so much for chatting with us.
It was a pleasure to be with you.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Robert Campbell, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter, online at realestatetiming.com. He's speaking to us from beautiful San Diego. Bob, welcome back to This Week in Money.
Thank you very much, Jim.
Bob, when's the next...
to talk to you and your audience.
Bob, when's the next issue of the Campbell Real Estate Timing Letter going to be published?
That will be July 15th, 2022. On May 15th of this year, that was the last publication that I put out. I put out a letter every 2 months.
Bob, the Bank of Canada just raised the official bank rate by 0.5 point this week. It sounds like the Fed will do the same thing mid-June. Does the Fed have options other than raising interest rates going forward?
Oh, of course, they always have options, Jim. They and I was I think the Bank of Canada is interesting that they're being aggressive with this. What's the real rate of inflation in Canada right now?
Oh, real? Probably.
I mean, when you say legitimate, what is it? I mean,
8%, I would think.
Okay, is that a government figure or a real world figure?
The government's a little lower than that, 6.7.
Okay, so we're here in the right. So they're going after that, in a meaningful way, because that's what it's going to take to stop inflation. Whether the U.S. follows suit, to me, is at best a coin flip, because I know the repercussions of that. Because that if you look back at the inflation of the 1970s, what the U.S. national debt was, it was approximately $500 billion. $500 billion, $1/2 trillion. Today, it's $30 trillion. In other words, it's 60 times greater. So even a little tiny increase in the interest rate is going to be magnified, hugely as what impact this is going to have on the amount of money needed to service the debt and the amount of deficit spending. So whether they're willing to raise rates to crash the economy, which is essentially what it would do if they did a 1970s Paul Volcker kind of thing here in the United States, I think the jury is still out. I mean, people say, oh, they have to do it. Yeah, they have to do it. The question is, to save things, will they? Because what it's going to do is it's going to crash the asset markets, and rich people have own 90% of the assets, and they're in control of things like the Federal Reserve and all that. So I think that they would rather live with inflation and everybody protects the amount of money that they have, or at least hold their own, than raise interest rates to break inflation and have the stock market down, 50%, real estate go down 50%, and just wipe out asset values. I'm betting on increased inflation.
If the Fed continues to raise interest rates, what could happen to the housing market? And what could happen to the housing market if the Fed stops raising interest rates and lets inflation run higher?
That is such an excellent question. That, okay, if they raise interest rates, housing's pretty much screwed. I mean, because right now we're at the upper end of affordability, guys. In the past 2 years, the average mortgage payment here in the United States has risen by 50%. And, that's because of two things. Housing prices are up like 30%. They're still rising at a record annual rate. They're breaking new records again. They've never risen faster than they are right now on a year-over-year basis. Plus, 2 years ago, mortgage rates were at least 2 percentage points lower than they are today. So what we're at the point of reaching right now is the upper limits of affordability, and that will shut down buyer demand. And if it doesn't shut down the buyers, if they're dumb enough to spend half of their income on housing at a super elevated level, then who's going to shut them down? The banks. The banks won't lend, guys. They just say, no, we're not going to let you spend 50% of your income on a house after housing prices are up 200%, in the past 14 years. No, we're not going to do it. You need to get that level down to, like, let's say 40%. So you're going to have to come in with another 20% down, which of course most people don't have. And then the tide turns. So the banks tell them they can't get any money, and all of a sudden, then a lot of people go, I'm not going to spend 50% of my income, and then all of a sudden, instead of it being a greed-driven market, it turns into a fear-driven market, and fear is contagious, and it feeds on itself, and now we're on the down cycle. That's the way cycles work, guys. That isn't speculation. That's just pure history. Human emotions, pure history, and that's what's going to happen.
Does the real rate of inflation look like it's increasing?
Yes, it is increasing. And because you can't believe what the government's telling you. Almost everybody knows that. Unless you're just a true believer. Everybody knows it's much higher. So here in the States, let's say it's 8, it's at least 10, it's at least 10, if not 12, if not higher. And another thing about inflation, the rate they're saying, is that housing components, compose about, I think it's up to 40% of the rate of inflation. Housing is so lagging, because they use the owner's equivalent rent and things like that. Rents have gone up in the last year here in the United States, 15%. Well, according to the owner's equivalent rent, where they survey a bunch of homeowners and ask them what their house would rent for, these guys don't have a clue what their house is going to rent for. It's at 4.5%. So as soon as all of a sudden that gets up to 10% or 15, whatever's normal right now, inflation just by the pure mechanics of mathematics is going to go higher.
Are we likely to see inflation in some areas and deflation in others?
Well, you're going to see inflation in consumer goods, that's for sure. Where you're going to see deflation is in asset prices. Especially on a real basis. For example, during the 1970s, and the reason I'm mentioning the 1970s, guys, here in the United States, is that was a hugely inflationary period where inflation averaged 9% a year for 10 straight years. That was the average. And it had decimated the U.S. stock market. The Dow Jones, it was on a real inflation-adjusted basis, even using the understated government numbers, was down 50% over that 10-year period. 50%. Housing almost held its own. Housing appreciated, on a nominal basis at 9%. Inflation was at 9%, so that held its own. Whether that's going to happen again, is anybody's guess. Because here's the big difference now. The leverage is so much different, guys. Everybody's leveraged up to the gills. And if we get into an inflation, everybody's leveraged, and all of a sudden we get highly leveraged, and we're getting into a recession where people start losing their jobs. And a job loss is the most devastating thing that can happen to an individual. Lose your job. Now you lose your source of income. And if you can only survive a month anyway, now you're really screwed. But if you over leverage on your house, you owe on your car, you owe on your boat, you have student loan payments, you're just done. You're just done. You're going to crash like a Tiger Woods rental car. It's just because, and it's all about the leverage. And I'll be talking about that again. Everybody is so leveraged today. And that just magnifies the risk.
What's the latest on real estate in the U.S. and California?
Oh, it's going up at record rates, guys. The year-over-year rate of appreciation has never been higher. According to Case-Shiller and CoreLogic, we're well over 20% a year. Over 20% a year. And using the Rule 72, that means in 3 years the housing prices are going to double from here. So here in California, I think the median price home is now inching up toward almost $900,000. That would mean it would be $1.8 million 3 years from now if these trends continue, rising that fast. Of course, they don't have to keep rising that fast. They could just slow down and rise at half that fast. But especially in California, which is my area of specialty, because this is where the market is. This is what everybody looks at: California real estate. Anybody that doesn't know that California real estate is extremely cyclical hasn't been alive long enough. It's set in stone, guys. And so it's going to come down hard, just like it always has. And it's just the nature of things. And it's coming. Not yet, though. And when I write my timing letter on the final page and final words, right above my final words, I have a little box. And when things are good, I put a bull in there. When my indicators tell me that prices are going to keep rising, I put a bull in there. When they're likely to fall, I put a bear in there. I still have a bull in there. I still have a bull in the box, guys. Do I think these are high risk times? Absolutely. Absolutely, yes. But does that mean they can't rise higher? Absolutely not. Or to say, they can't rise any higher than that. Hey, I've been around way, 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 way too long to know that's not true. They're going to rise as high as they're going to rise. But all of a sudden I'm seeing the cracks right now. We're at the upper limits of housing unaffordability, according to what's in the past. So I think within the next 6 to 12 months, a major market downturn is going to begin, and it's probably going to last 6 years.
With debt bubbles everywhere, what could be done to avoid a housing crash?
What you could do to avoid a housing crash is start dropping interest rates again, because that's what made the bubble. Was they forced interest rates to record lows while they pumped up the money supply, and that's why housing prices are appreciating at record rates right now. If they want to keep pumping money into the system, stimulus, free money, stimmies, and force interest rates back down, to even lower levels. Maybe mortgage rates will get down to 2. Maybe they'll get down to 1. Housing's going to inflate. Everything's going to inflate. And in other words, and they can keep the bubble, pump the bubble up for just a little while longer. But as Warren Buffett says, one of my favorite sayings from Warren Buffett, the bigger the binge, the bigger the hangover, and that's what's going to happen. It is. It's just artificial. They've jacked the money supply up, and they've put interest rate at record lows, in order to keep things from crashing. So can they continue with that? Sure. Nothing's stopping them. But when the crash comes, it's just going to be that much worse.
In real estate markets, which emotion is greater, the fear of missing out or the fear of not getting out?
The fear of not getting out. Because the fear of missing out is driven by greed. The fear of not getting out is driven by fear. And fear is a much more dominant emotion than greed. They've conducted studies before, and they found out that the thrill of making, the agony of losing a dollar is twice as great as the thrill of making one. And that's what happens. When you say that fear is a more dominant force, on the downside, people get scared, really scared, that they're going to lose everything. They're going to lose their house. They're going to lose their job. They can't make the payments. And so that's the dominant fear. I mean, dominant emotion. And that's what's going to take the cycle down. It's going to be fear-driven instead of greed-driven. Understand, everybody, all markets. That's why I don't follow fundamentals. I follow technical indicators that I've learned from trading stocks for 50 years, and I apply them to real estate, and they work like a charm. But all markets, whether it's stock market, whether it's a real estate market, whether it's the baseball card market, 50% of those markets are driven by market psychology. Market psychology. And so you gotta pay attention to that. That's why fear feeds on itself, and so does greed. And that's a very, very real driver.
Do the stock markets look like they're in a severe correction or a bear market?
Of course, that's in the eye of the beholder. It looks to me like they're in a bear market. Because it looks to me like they're in a bear market. Because, I mean, it's not like stocks, I think the S&P 500 or something is down 13%. The NAS is down like 25%. I mean, the NAS is definitely in a bear market. The S&P and the Dow, probably in a bear market. But if you look at some of the individual stocks in those things, they've been decimated. Some of these high flyers, even Netflix and things like that. These stocks are down 50%. And so what's holding them up? Energy stocks, some of the strong industrials, they haven't done too badly. But a lot of underlying stocks have just been absolutely killed. Absolutely killed.
Are there business strategies that could survive a significant downturn in the economy?
Absolutely. And here's the first rule, guys. Rule number one, when you're in a falling economy or falling markets, take down your leverage. Take it down. Do whatever you have to do to get it down. Because the first rule of business in a down market, especially, is to survive. So you gotta take down your leverage. Then what you have to do, step two, do whatever it takes. Like if you're in the construction business, and you're in the building business, are you gonna be doing spec homes? No way in the world. Dumb thing to do. Stupid. Get away from it. Take the leverage down. Manage the downside risk. All of a sudden, even if you're a general contractor, and all of a sudden you got a contract on something where all of a sudden somebody's hiring you to build a house, and you're out there with, inflation and rising costs of materials, which are now rising at over 20% a year, both labor and materials. You've got to take that risk into account. You sign a contract. I will produce this house at this price. All of a sudden, now let's say, construction workers, which are as rare, idle construction workers right now are as rare as hen's teeth. You can't even, from people I know in the business, you can't even get them, subs and general contractors, to return a phone call. That's how busy everybody is. And I've confirmed that with some of my own guys. So all of a sudden it gets busier and busier. These guys are raising their prices. These guys are the material costs are going up. All of a sudden, to finish this house, it could cost you 20%, 15%, 10% more than is in your bid. Most people are bankrupt. So you gotta take down the leverage, and you just gotta, whatever it takes to reduce your risk. And then everything goes well, that you'll survive. And the first rule of success in a down market is survive. Avoid disaster.
Is this a prevalent human behavior? People make big money and then lose it all.
Absolutely. I mean, and it's absolutely. I know that's not what the wealth merchants want you to tell you, but if you just look at 100 Americans, for example, that reach the age 65, and let's say they call that retirement. Only 4% are comfortable financially. Everybody relies on Social Security or family or something else in order to get by. Because the average American, his net worth, age 65, is something like $300,000, and most of that's in their home. So most people are not a big success when it comes to managing money and becoming wealthy. Far from it. I know that's something, that's like a dirty little secret nobody wants to talk about because, as long as they can keep the hope alive, right? It's almost like a gambler's addiction. As long as they can keep the hope alive that you have a chance, they'll do a lot of stupid things, and most of them end up backfiring on them. That's the reality of the real world, guys. And I can say this, for those of you that don't know, I'm 75 years old. You can't bullshit me anymore, and I'm not going to bullshit you. This is the way the world works. And believe me, there's a ton of bullshit artists out there. For example, what they like to tell you is like, long term. Real estate prices in California have gone up an average of, like 5% a year, adjusted for inflation over the class of the last 40 years. Is that a true statement? Yes. And that's about 3 or 4% greater than the U.S. So it's a true statement. What they don't tell you is the ride to get there. It's full of volatility, fear, pain, job losses, and a lot of times people that lose everything. Nobody tells you that part. They don't want to tell you that part. All they want to tell you about is the long term. Like and that they don't talk about what happens in the short term. Like everybody survives it. And that's completely false. Completely false.
Do you think many people in your age group are still working at what they love to do?
My age group now, I'm a baby boomer, guys. I would say, let's start with the number of people that love doing what they do. That's not a big percentage, guys. Still working that love what they do are people that have a lot of money and don't need any more. And why do they do it? Because they love it. And they're not even trying to make more money. That's not their biggest goal. They're just being active and staying alive because they're interested in this. But I would say most people in baby boomer age group that are working right now, no, they're working because they have to work, not because they want to work, And, as opposed to being in a position like I am personally. I write an investment timing letter for 21 straight years. I love it. I love doing it. I love it because I get interviewed like this. I have so many friends that go back, 20 years. I've made good friends. I find the subject matter incredibly interesting. It keeps me young. It keeps me sharp. And I will keep writing the Campbell Real Estate Timing Letter until I am dead. Because right now I am so good at it, I only have to work 1 to 2 hours a day to stay ahead of the trends. Because I know which indicators to watch, which ones to ignore, and I'll spend the rest of the time, working out, running hills, or playing baseball, playing hardball. But there you go, guys. One thing about doing something that you love and being really good at it, because then now you have a steady source of income. Now you have an income. Now you're not depending on the U.S. government or a pension from a government. You've developed something on your own that you can rely on. Yeah, and it wasn't until I was in my 50s that I wrote a book, Timing the Real Estate Market. So I have sold 31,000 copies, self-published, and write an investment newsletter. So from that standpoint, I have a very, very healthy and steady monthly income, come good times or bad times, and that's what gets me through everything. I haven't even touched my retirement money, and I'm a big saver. So, and at a certain point you get in your life, money is not the most important thing by far. Not even close. There's other things that you need to focus on. And I know we're going to talk about health and fitness, and it's on my mind right now, but I just read a quote from Confucius. It said, "A rich man wants 100 things, a man in poor health only one. And I have focused on my health, staying physically fit, which makes me mentally fit and mentally strong, and it's made all the difference in the world in my life, my God, you guys, all the difference. If I hadn't have done that, You know, I wouldn't be on this House Street interview. I wouldn't be doing a lot of things that I'm doing right now. So, I mean, it's all about that. We'll get into that at the end, but I just want to mention that. But, you know, money should be the least of your worries. In fact, I read a study once where they talked about who are the happiest people in the world. Happiest people in the world. And here's what they found out. They love what they do. They make a good income, let's say twice as much as the average American income. In other words, they're well paid. I mean, are they rich? No, but they're paid a good salary, so they're comfortable financially, and they have the least amount of things, guys. The least. They don't have boats. They don't have off-road motorcycles. They don't have jet skis. They don't have all this crap. Motorcycles, you know what? They're high-speed, low-drag, and they're good at what they do, and they're well-paid, and they're happy. So I heard that, and I said, you know what? I have a T-shirt that says high-speed, low-drag. I don't have a motorcycle. I don't have all that crap. You know, I just don't need it. I don't need it. Well, one thing, I live a mile away from, one of the most beautiful beaches in the world. I mean, and I don't want to drive around a motorcycle anyway. So do that kind of stuff. I don't get off on that. But anyway, that's what it takes, guys. You got to be good at what you do, and you're well paid, and then you're super happy. Plus, you have to have a good woman. You have to have a person in your life. You know, single people are rarely happy. You know, they just aren't. So you need a woman in your life that you love, that you adore, that you take care of, and that's pretty much it. You don't have to have $5 million in the bank to be happy. You know, if the average wage, if the average household income in the United States is $80,000, and you're making $160, and you're good at what you do, and you're comfortable, you're going to be happy.
What percentage of people are healthy as they grow older?
Small. I just went to a celebration of life for one of my grade school homeboys that I grew up with, and at 75, I wanted to see a lot of my old classmates, and a lot of them weren't there. But when I was there, I'll tell you, by far, I had an effective age of 30 years younger than most of those people, and it was a real eye-opener. Was it fun to see them? Oh, yeah. I don't care if they're in a friggin' wheelchair. We all grew up together. We all love each other. Good to see each other. But there's people on canes, on walkers, in oxygen, and they're 5 years, 10 years younger than me. So people don't take care of their health, guys. And you know what you have to do? You can't get to be 60, 65 years old and say, I'm going to get healthy, if you've ignored it your whole life. It ain't going to work. Unlikely, high probability it's not going to work. So when you got to start this, you got to start this in your 40s. No later than 50. You have to start developing the habit of eating right, working out, and especially it's all lower body. You got to take care of your lower body. You know, your legs are your fountain of youth. The fountain of youth. You got to take care of that. So you don't need a stick. So you don't need a cane. So you can walk standing upright. There's an old Russian expression. A wolf lives by his legs. And it's the same with human beings, guys. You got to take care of the lower body. I just got back from the gym today. And a lot of the kids in there, young kids who I love, that all the kids work on upper body. They want to have big, biceps and arms and doing big bench presses with chest. That's because they want to look big. Upper body strength makes you look strong. Lower body strength makes you invincible. And I hope you guys remember that, because you know who told me that? Well, a gym that I used to go to, an ex-Chicago Bull that played with Michael Jordan for 10 years. He saw me working out and he goes, Bob, I really like the way you work out. He goes, you focus on your legs. And I go, absolutely. And he said, that's the way athletes train. And he goes, your legs are a fountain of youth. I'd never heard somebody make that connection, but he's absolutely right. You gotta take care of your legs. And especially when you get older, one thing you don't want to do, you don't want to fall down. So how do you avoid falling down? You have strong lower body strength. It's that simple.
Well, Bob, I was going to ask you about health and fitness tips, but I think you just gave it to us.
Oh, there's more. Believe me, you guys. There is more. Hey, do we have a couple more minutes?
Sure.
Okay. Hey guys, I'm reading a book right now that I would recommend all you guys reading. It's called Can't Hurt Me. It's a book by a Navy SEAL named David Goggins. Can't Hurt Me. And let me tell you a little bit about, and that book has been like pure cocaine to me, because it has resonated with me. Because to become a Navy SEAL, let's just say for an example, you start off with a class of 100, and they do the Navy SEAL training here in San Diego, down on Coronado Beach. It's 6-month training. If 100 guys are in the class, originally in the class, 15 to 20 will graduate. Only 15 to 20. And the difference between what makes the difference, I guarantee you, the people that are allowed to become a part of that class, the 100 initially, they're all badass guys. But only 80% to 85% fail. And you know why they fail? It's all mental, guys. It's mental. It's mental toughness. So whatever you want in life, whatever you strive for, it's going to be mental. And I knew that, but now I know it, even better. That I run up hills every other day. 2 years ago, I could only do it twice a week. So one day I said, I ran up hills, and the next day I said, I'm feeling pretty strong. I said, you know what? I'm going to try that hill again. And I was fine. Next day, I ran it for the 3rd day in a row. Then I did 4 days in a row. I ran up that hill 28 straight days, guys. There's no more proof than that. It was all mental. You think you can't do it, and you can do it. So I don't care whether it's physical fitness, whether it's whatever you endeavor to do in life. If you don't have the mental toughness to hang in there and not get discouraged, you're not going to really make anything. And in order to develop that mental toughness, you know where it starts? With physical toughness. You can't be a big blob and all of a sudden think you're going to be mentally tough. You're not. It starts with the mental fitness, and it goes up into your brain. Physical fitness develops mental fitness. And you have to be mentally fit to say, I don't care, you know what, nothing's going to stop me. Whatever it takes, guys, I'm going to push things to the extra mile. I can do it. Don't say, oh, I can't do it, because you can do it. And so, you know what? You have to develop that mental toughness, guys. And I wish I had learned about it, before I was 70 years old, but better late than never, right?
Bob, how can people find out more about your book and newsletter?
They can find out more about my book and newsletter by coming to realestatetiming.com, just like it sounds, realestatetiming.com. And you can read a sample issue of my timing letter. You can buy my book, Real Estate Timing the Real Estate Market. And let me end on one note, guys, because I'm really amped up on this. You know what I'm thinking about doing? I'm thinking about doing Navy SEAL training for guys over 65. Is it going to be like real Navy SEAL training? Kinda. But you're not going to be hauling logs that you can't carry. But a lot of the mental fitness, the physical fitness, just to show people what you can do if you put your mind to it. But so anyway, that's why I'm so amped up about this. I love what I do. I love talking on HowStreet.com. I love telling you guys about, market conditions, because I've just trained myself to follow the right indicators, ignore the wrong indicators, and make, data-driven decisions and data-driven projections about what's going to happen. So it's all together. In order to do anything well in life, you have to be physically fit. And that develops mental fitness, and then all of a sudden, now you got a good chance. So, realestatetiming.com. And also, by the way, that you can go there and it says next seminar. My next seminar is going to be in September 17th, 2022 at the La Jolla Marriott, and it's titled, How I Stopped Worrying and Learned to Love Inflation. And what that's about, guys, is adjusting to whatever the prevailing trend is. If real estate's going to go down, get out of real estate and get into something else. Possibly something that's going up, like commodities. I'm invested in commodities. I've been invested in commodities for the last 6 months. My account is up 50%, and the Dow Jones is down 12%. It's all about the cycles. Study inflation and find out what does well inflation and get into those asset classes. Commodities are going to do energy. I think energy is going to over $200 a gallon. I am convinced all these leaders, Trudeau, Biden, they're trying to crash the world economy. Everybody wants to go green. Where you don't need fossil fuels anymore. Yeah, just wait. Oil's going to go over $200 a gallon, and commodities are going to soar. And there's one way of protecting yourself. And get out of things that don't do well during inflation, and get into things that do well. And so, you got to be kind of sharp to figure that out. And the way to do that is be mentally and physically fit. That's a good start. And not be stupid.
Bob, thank you so much for chatting with us.
Thank you, everybody. Talk to you again next month. Bye.
My guest has been Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter. You can find him online at realestatetiming.com. He was speaking to us from San Diego. Coming up, Wolf Richter next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money, Wolf.
Thanks for having me back, Jim.
Wolf, given that everyone is struggling with inflation, how are American consumers hanging on?
Yeah, it's not really amazing, but it is kind of amazing. We have seen this now month after month, and we've seen it in the first quarter. We've seen it last year. Even when adjusted for inflation, consumer spending is pretty strong. There's some big shifts going on within that consumer spending from goods to services. So spending on services is surging. And services include healthcare, include housing services, include insurance and education and travel services, sports events, entertainment events, that kind of stuff, cruises. And people are spending a lot of money on this stuff now. And the thing is, these discretionary services, they kind of collapsed during the pandemic. And that includes elective healthcare procedures. And so now all that's coming back. The dentists are busy, and all these services are now being used, and people are paying for it, and on an inflation adjusted basis. In April, so that's the last figure we have. They're up 6% roughly from a year ago. That's strong. 6% increase for the United States economy of anything is a big thing. And, it's a mature economy, and so that kind of growth is strong. Whereas, adjusted for inflation, spending on goods has dropped a little bit. There was this huge spike last March, April, when we had the stimulus payments going out, and people went and bought cars and, smartphones and computers and, all kinds of other stuff and furniture. And that's now backing off. And compared to this huge spike last year in March, April, good spending has now declined a little bit. We got to remember that consumers spend about 70% of the total spending on services. So, the 6% increase in services easily outdoes that relatively still smallish decline in spending on goods. So, 2.8% is what total consumer spending rose in April. That's roughly in line with a fairly decent month before the pandemic. Consumer spending grew between close to 0% and 4% in that range in the 10 years before the pandemic. So 2.8% is just right at just above the middle, and it's it's all adjusted for inflation. So, the consumers are spending money for now, and employment is strong. They're making money. They're getting pay increases. Of course, those pay increases are not enough to make up for inflation in many cases, but they're spending it, and they're spending some extra, and they've got money from the huge amounts that were made in the stock market and in cryptos over the past few years, even though they've given up a lot of that now. But, they still have some of this in real estate. They have refinanced the mortgages and gotten cash out, and they've lowered the mortgage payments to have a smaller monthly expenditure. And they've done that over the past 2 years, and so that's kind of come to a halt, but they still have all this money. So there's this huge amount of money in the pipeline, and not just consumers, but everywhere. And we see that in businesses and state and everywhere. There's stimulus money that the government send out to all these entities, and the money from the Fed. that's still circulating through the system. And, and consumers are spending. And that's just, that's why we're not looking at a recessionary scenario right now. As long as consumers spend like this, it's hard to have a recession. And, at some point, maybe that might turn around, but for now, they're outspending inflation, and by fairly decent margin, and spending is shifting to services. So the retailers may have a hard time, and you'll hear some recessionary talk from that corner, but that's all goods. Retailers sell goods. And their spending is shifting from their stores and their online sites to services, to airlines, and to insurance products, and to housing services, and healthcare services, and all kinds of things that retailers don't sell. So you'll see retailers retrench. And they've had a huge spike last year due to stimulus spending, and that's coming down. So retailers are having a little bit of a problem there. But in terms of service providers, they're rocking and rolling. And, right now, that's what we're looking at. We're looking at a lot of spending from consumers. And, of course, that's the aggregate. That's not individual consumers. There's some consumers that, obviously are tapped out, and but in aggregate, they've paid down their credit cards during the pandemic. Credit card balances are, have fallen sharply, and they're up just a little bit from where they were 12 years ago. And there's a lot more people now that have credit cards, and we've had, 12 years of inflation during that period. So, consumers have all kinds of resources now available to spend, and they're using them. And we see that. And in addition to the pay increases they're getting, they're using these other resources. And for now, it's holding up. I don't know how long. At some point, maybe they'll go on a buyer strike and say, I've had it with these higher prices. I'm not doing this anymore. I'm out of here. And I hope they would do that, because that would end inflation. But right now, they're not doing it. They're scrambling to buy stuff before it gets even more expensive. And that's the inflationary mindset. And we're seeing that. And so, that's the American consumer, just spending money.
You've been calling the current stock market situation the dot-com bust 2.0. How do you figure that?
Yeah, so, people who remember the dot-com bust when it happened between the spring of the year 2000 and into 2002, and actually stocks stayed down for a long time, and the Nasdaq didn't really come up seriously. It went up, and then we had the financial crisis and went back down to near the low of the dot-com bust, and it didn't really come up and surge until the Fed started printing money in 2009. And so this is the scenario we now have. The Fed has stopped printing money. It is now starting quantitative tightening, so it's going to shed some of the securities and at a fairly good clip that it has bought. And the stock market cannot stand on its own 2 feet without the Fed's interest rate repression and the Fed's money printing. And so now it's unwinding. And the craziness that we've had in the stock market is just mind-boggling. And, we've had these do-nothing companies with no products and nothing to show for, being worth tens of billions of dollars, and new companies being new IPOs and these SPACs, were starting to trade publicly, and so all these companies were sold to the public, and we're talking about hundreds, and at huge valuations. And starting in February last year, they started coming down one by one, so down 70, 80%, 90%, many of them. Some of the big ones too. I mean, even Netflix is down over 70%. And this is from the highs, so from these ridiculous highs that they have achieved. And now when a stock is down 90%, that's pretty significant, and it's one company after another, and I'm tracking them now. I mean, I have close to 200 stocks now on my watch list that are down over 70%. And these are names, these are stocks that people know. And companies that have stature, they have products out there that people know about, at least the stocks that people know about. And and they have just gotten crushed one after the other, and it's still going on. And in November, finally, some of the bigger ones like Microsoft and some of the others started keeling over, and that's when the Nasdaq started going down. Until then, those startups and SPACs collapsed on their own, with the big stocks covering up the damage. Now, the damage is all over the place, and the big indices are dropping. And we've had some huge bear market rallies. We're going to continue to have these bear market rallies, just like during the dot-com bust. During the dot-com bust in the summer of 2000, in the middle of the Nasdaq going down 78%, the Nasdaq had a 35% rally. And in like 3 months, and it pulled in a bunch more people that thought that this sell-off is over, and they're going to get rich, and they got wiped out. That's how the bear market rallies are so vicious. They're incredibly powerful rallies. You don't even, they start and suddenly they shoot higher, and you jump back in to chase the stocks, and then and suddenly it's over, and they plunge viciously. And people couldn't get out, and that was Wipeout City. And the real damage didn't occur in the Nasdaq until after that bear market rally in the summer of 2000 collapsed, and and that's what we'll be seeing too. We'll see some huge big bear market rallies, but everything is overvalued by huge amounts, and a lot of garbage that should have never been publicly traded, should have never been sold to the public, it's going to zero. And these stocks are not going to rebound. These companies are going to run out of money and shut down, and the stocks are going to go to zero. We've seen that during the dot-com bust. We're seeing it now. There's already some companies that are indicating that they're going to run out of money pretty soon, and unless they can raise more money, which they won't, many of them won't be able to, they'll shut down, and the stocks go to zero. There's no bounce back there. And, we remember the biggies that succeeded out of the dot-com bust, Amazon and a few of the others, eBay and just a relatively small number of companies. We don't remember the hundreds and hundreds of companies that shut down and disappeared, and the stocks disappeared, and we don't really look at the survivors of the Nasdaq bust that are still penny stocks. They're still out there. You can still trade them, and they're worth $1 or $2. They were worth $100 or $200 in early 2000. So, this is what we're looking at here, and we've had this incredible, crazy, mind-boggling stock market bubble, and fueled by Fed money printing and interest rate repression. And now we've also had the cryptos. And there's already been a huge amount of bloodletting in those stocks and in cryptos. I mean, trillions of dollars have already gotten wiped out. And, which already exceeds the damage from the dot-com bust at this point, in dollar figures. And, so, that's what we have. It won't be over shortly. This is not something that when shares go up today, that's a sign that it's over, that this was the bottom. We're not anywhere near the bottom. We have not had any kind of panic. We have not any kind of fear. Everybody is just day trading this stuff now and trying to buy the dips, and so we are a million miles away from the bottom. And and I've never seen a stock market bubble like this, and it's unwinding. That's just how it has to happen. And for the overall economy, this may be a little rough for a while, but it's a good thing when the zombie companies disappear and allow viable, profitable companies to do the thing. And the bankruptcies will allow companies to shed their debts and then reemerge with less debt. Corporate debt is a huge problem in the United States. So a hard stock market sell-off will prevent these companies from raising new money, and so they will file for bankruptcy and will shed their debts that way at investor expense. That's how it should be. And then they reemerge, and they have less debt. So there's a lot of good to be said for that, for the kind of cleaning process that comes out of this. But right now, with the Fed raising rates on a fairly steep track, and with QT starting, this is going to drag out for a long time.
Are these sky-high gasoline prices causing consumers to cut back on driving?
Yes, I'm watching this, and I've seen some demand destruction in gasoline. Not a huge amount, but there has been some, and it's kind of hard to tell where this comes from on the initial data. We've seen that when consumers have two cars, they'll prioritize the most efficient vehicle if they can't afford to leave one of them in the garage. They might not do a few trips, they might do shorter trips, or they might drive more conservatively. Those are short-term demand destruction events that come fairly quickly. And sorry about that. These are short-term events that come and go fairly quickly, but we now are seeing long-term demand destruction setting in that vehicle buying patterns have shifted from big vehicles, from pickup trucks and big SUVs to small vehicles, to cars especially. And so now we're starting to see inventory buildup in pickup trucks and cars and SUVs and dealers, new vehicles. Dealers are practically out of cars. So the American automakers have thrown in the towel on sedans. They've killed nearly all of the sedan models. So what is now in demand are cars, and they're manufactured by import brands, even though they may be manufactured in the United States. But they're import brands now, and their dealers are out of those cars. Fuel economy is suddenly really important when people buying cars. So these are long-term shifts. Those cars are going to be in the national fleet for a couple of decades. So this will have long-term impact. There is also huge demand for EVs. Nobody can build enough EVs, just like building cars. There's a shortage of new vehicles. It doesn't matter what the powertrain is. And so it's really, really tough right now to buy EVs. Ford has huge waiting lists for its pickup trucks, for the electric pickup truck, the Lightning, and that's already delivered the first one, so that's on the market now, gradually trickling out. Tesla has waiting lists. Everybody with EVs has waiting lists, and this is a shift in demand that is long term, and so I think we will have seen peak gasoline consumption. I think that was in the years 2017, 18, 19, and we've had a previous peak in 2007, and then the trough from the financial crisis, and there were shifts, long-term shifts like that, and then gasoline consumption never got back up to, or didn't get back up to the 2007 level until 2017, so 10 years later, roughly 2018. And it kind of stayed there. So if you draw a line across, there's really not much of an increase between, say, 2019 and 2007, just a small increase. And other developed economies have shown similar pattern where gasoline consumption is actually down over the years. And because fuel economy has gotten so much better in these vehicles, even larger vehicles have a much better fuel economy than they used to have. And so that's kind of built into the system now. So what we're seeing today is probably an acceleration of that demand destruction. And, my guess is that 2019 gasoline consumption was the peak, and, it will go down from there, and we'll never go back to that level of gasoline consumption.
With high gasoline prices, are people switching to electric vehicles thinking that they're more viable more affordable to run.
Yeah, so there's huge demand. There has been huge demand for EVs, and people are trying to buy them, and there are waiting lists and backlogs, and semiconductor shortages hit EVs just as much as ICE vehicles, internal combustion engine vehicles, and no vehicle manufacturer right now can build all the vehicles that they have demand for. So this is a problem across the board with gasoline vehicles as well as EVs. And that's an issue that's not going to get resolved this year. It looks like, semiconductor shortages are now expected to persist into 2023. So, they're still not going to be able to build all the vehicles they want to build. It's hard to guess what demand really is if there's such a huge supply shortage. And, that is just, we're just guessing what the actual demand for EVs is because, we can't build enough right now and nobody can. We don't, overall new vehicle consumption has plunged, and what's really selling are EVs, and there's huge demand for them. There's much less demand for vehicles with internal combustion engines. So these higher gasoline prices have further accelerated that, and it makes even more sense today to buy an EV for most, especially for people that, if you have to tow a horse trailer across the continent as part of your living, you need a vehicle that's equipped to tow something like that. And so maybe the early versions of EVs that are coming out may not be great, because they're just not designed to tow a trailer with 4 horses, even though they have a lot more power than even the big diesels have, and they can easily tow it, but it's just not that kind of vehicle. So there's a small number of people that have special use vehicles for which EVs are probably not the most suitable at this point. But for the rest of Americans, EVs are great and save you a lot of money. And you plug them in at night in your garage or outside the house, and you top off the charge that you lost during the day. It's not a whole lot. You can easily do that. You don't have to go back to the gas station. You don't have to go to a charging station because you do that at home. And they're so efficient. They use so little energy because of the regenerative braking system. So we have a hybrid, and the only thing that charges up the battery in our hybrid is the braking system. When you get off the accelerator, the electric motor turns into a generator and slows down the vehicle and charges up the battery. And, that's a lot of energy that you recapture, and we use that. We drive with that energy, in our hybrid. That's how they're designed. And, in addition, electric motors are, something like 90% efficient. A gasoline engine, when it's idling, is 0% efficient. 100% of the energy goes into waste heat. When it's cruising at its most efficient level on the highway, it might be 35% efficient, and the other 65% are waste heat. The braking system is waste heat. ICE vehicles are incredibly wasteful. And, so the energy consumption by an EV is a lot smaller. And because ICE vehicles are so wasteful. So it makes a lot of sense for all kinds of reasons to buy an EV, if you have the kind of battery that allows you to go through your daily life on one charge, which for most people, that's more than easily possible. People don't drive 200 and 300 miles every day. A few people do, but not many. Most people just drive, 40 miles, 50 miles, 60 miles a day, and they're topping off their EV in their garage at night. In the morning, it's fully charged, again. And, so, and that people are catching on to this, and they're catching on to the enormous amount of torque that electric motors have, essentially right from the beginning. So even a small electric motor will outperform a gasoline engine. And, so, and this is just consumers are choosing. And they have a choice now. They can buy anything they want. They can't get it right now because nobody's making anything. But in theory, if they can get it, they can buy anything they want, and they make their choices. And right now, the demand is on EVs. That's what demand growth is. That's why every manufacturer is piling into it. BMW completely dropped the ball on it, and they cleaned house a couple of years ago to get into it. They still don't have, they have EVs, but they're afterthought EVs. They're not designed as EVs. They just put a regular car, took the powertrain out and put an electrical powertrain in it. It's completely idiotic. But Ford is coming from American automakers, behind Tesla. Ford is probably the closest. And, they know where the money is, and that's where they're going, and that they know where the demand is, and these high fuel prices are just going to heat up that demand for EVs. And granted, electricity prices have gone up too. It's not like they went down; no, they went up, and so the higher gasoline prices are set off by higher electricity prices, but you're using so little electricity in an EV because it's so efficient. So the equation still works out very well, and people that are driving EVs on a daily basis, they save quite a bit of money.
Canada just raised interest rates again by 50 basis points. The Fed looks like it's set to raise 50 basis points mid-June. It sounds like the Bank of Canada and the Fed will continue raising rates possibly the rest of the year. What does this likely mean for the most splendid of housing bubbles?
Yeah, so the splendid housing bubbles that, I have two series on my website, wallstreet.com, one for Canada's most splendid housing bubbles and one for America's most splendid housing bubbles. And, we've always seen the housing market turn around in Canada and Vancouver. Prices are already starting to decline. The inventory is starting to rise. Sales are going down. We're seeing similar things in the United States, except we're behind here. So we've seen volume drop across the board quite a bit. Now we're seeing inventories coming up. New listings are coming up. So the shadow inventory is now coming out of the shadows. Prices are the last thing that will move. People want to hang on to their prices. But now we're seeing an increase in price reductions in order to sell a house. And, this has the hallmarks of a housing downturn, and it's more advanced in Canada than it is in the United States, but we're seeing the dynamics of it. And housing downturns take years to play out. The last one took about 5 years, so it's not something that you just see on your screen instantly on a day-by-day basis. So you have to be patient to see it. The first year of the housing bust that we had, starting in 2005, 2006, we didn't even know we had a housing bust while we were in it. It was just kind of plateauing and going down a little, and volume had dried up, and people couldn't sell their homes, and then people defaulted on the mortgages, but prices were still kind of hanging in there a little bit. And, we were in it for a year before we realized, oh my God, this is really a downturn. And then looking back, we now know when it started. So you're taking out buyers, and you're taking out each time mortgage rates increase, you're taking out another layer of buyers. And it takes buyers to make a market. So when the buyers aren't there, the sellers put the home on the market, and they, instead of getting 20 offers at first, they get 3 offers, and then they get 1 offer, and then a little while later they get no offer, and the house sits on the market for a month, and then they pull it off the market, and maybe they'll lower the price, put it back on the market. And so you start this whole game, but the sellers are very reluctant to lower prices. That's the last thing they're going to do, and they want to sell the house at the maximum price, so the listing prices are going to be very high. They're kind of aspirational prices, and the buyers refuse to buy them. Then you got a decline in sales. The market kind of freezes up, and buyers say, oh no, I'm not buying at this price, and the sellers are sitting on their homes, and we're starting to see some of that, and we're seeing it to a larger extent in Canada than we're seeing it in the United States. So these much higher mortgage rates, and right now, the Fed hasn't really raised interest rates much, and mortgage rates have gone up by our benchmark mortgage rate has gone up by roughly 2 percentage points. And, the Fed and Bank of Canada are now on track to raise interest rates pretty aggressively. They're shedding the balance sheet, so that's going to put upward pressure on long-term interest rates, and including mortgage rates. The Fed has stopped buying mortgage-backed securities and it's going to start shedding them. So that's going to put upward pressure on mortgage rates. It doesn't take a genius to figure out where this is going at these sky-high prices. We had 30%, 20%, 30% increases in home prices in all kinds of cities across the country. In just 1 year, if you go back 18 months, it's even more, and it doesn't make sense anymore. Mortgage rates are 5 or 6 or 7%, as they are in the United States. 5% is what we have right now for the 30-year fixed, and so we're looking at higher mortgage rates going forward. This is, it just can't work out. It mathematically doesn't work out, and so we know what this will do. And the housing market, the housing bubble, this is what this is. They're being targeted by the central banks. They don't want the financial system to blow up because of these overvalued home prices. This is collateral, and when the collateral value collapses, the loans or the mortgages lose value, and then you have this whole issue of another mortgage crisis that's blowing up the banks, and this time it's not really the banks that are on the hook, it's the taxpayers that are guaranteeing them, and it's the investors that have bought these mortgage-backed securities. It's not necessarily the banks, so it's a different kind of a problem. And the central banks are actively targeting this. They don't want this housing bubble to get worse. They need it to come down, and that's where we are. It's just basic. There's no secret about it. It's not speculation. It's just how it works. When you have these overinflated home prices and you raise mortgage rates, prices come down. Just like after a large sell-off in the housing market, when mortgage rates are lowered, the home prices rise. We've seen that. This well-established relationship between mortgage rates and home prices, and that's playing out.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Robert Campbell, and Wolf Richter. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.